All right, let's get back into our chapter 9. The next method of depreciation we're going to learn is double declining balance. And so to review, we learned straight line. Straight line is the easiest because it's the same every year. And so in the denominator, you just do the number of years and it's the same each year. Units of production is a little bit more complicated because instead of years, you divide by some unit of production. So it's the same amount per mile instead of per year. Because in this one, we had a year in the denominator, and this one we had a mile in the denominator. So an amount per mile, and then you have to know how many miles. And that could be a copy, it could be a machine hour, it could be whatever. So the last method I'm going to teach you guys is called double declining balance. And double declining balance is probably the hardest method. The formula is completely unrelated to the other two methods. So what we do is, this is an accelerated method of depreciation. So when I say accelerated, it means that it's more in the early years and less in the later years. So basically, most businesses, when they buy a piece of equipment, they pay for it up front, like they pay for it in that first year. So you're allowed to take more depreciation in the early years and then less in the later years. And so declining balance doesn't have to be double declining balance. My upper level students learn another method called 150% declining balance instead of double, but the word double is meaning 2. So the formula for it will be book value times 2 divided by useful life in years. The 2 because it's double. So if it was 150% declining balance instead of 2, it would be 1.5. So remember that the book value is cost minus accumulated. So you'll take cost minus accumulated, and then you take it times 2 divided by the years. This method doesn't pay attention to residual value. With our straight line method, we do cost minus residual and then divide by years. But this is cost minus accumulated. And then we will just have to stop depreciating when we get to the residual value. So the best way to understand this method is to just do an example of it. So let's go ahead and let's do this example. And so in year 1, we've got an asset with a cost of 110, a salvage of 20, and a useful life of 5. So again, I still need those 3 things. The cost, the residual, and the number of years of useful life. And then from there, my formula will be book value times 2 divided by years. Now, years in this situation are 5. But it could be an 8-year asset, and then in the denominator, it would be 8, or a 3-year asset, and it would be 3. So in the very first year, the book value is cost minus accumulated, but accumulated is 0, right? In the very first year. So I'll take 110 times 2/5. When I do that, I get 44,000. So my depreciation in the very first year is going to be $44,000. Now I'm going to pause a second. And if you were doing straight line here, you would do 110 minus 20 and then the denominator instead of like you would do 5 years, right? So it's a 5-year asset. So you get 18,000 of depreciation. And so that's how much you would get if you were doing straight line. So you can see that this is an accelerated method, that we're getting a lot more depreciation in the early years. So at the end of the year, then we would do, remember, book value equals cost minus accumulated, right? So the cost of the asset is 110 and the accumulated is 44,000. So my book value is 66,000. Now I have to compute that. I have to compute that before I can go on to the next year, because the next year I am not going to use this formula again. The formula is book value times 2 divided by years. So my book value for the next year is going to be 66,000 times 2/5. So notice that every year my book value is going to drop and I'll be getting less depreciation and less depreciation. So when I calculate that, 66,000 times 2/5, I get 26,400. So over here, I don't love the way my table's set up right now. because I need to know what the accumulated is, right? And the accumulated is the total of these two. So my accumulated, if I were to just identify it, I wish I had a column for that. But my accumulated, if you take 44 and 26,400, it's 70,400. So that's how much total depreciation I've taken now. Again, that's a lot more than I would have. If I was using straight line, it was 18, so I'd only have 36. I've got 70. So I'm going to do 110 minus 7,400. Now I could have just taken 66 and subtracted that, but I like to show my formula for book value. Because if I sold my asset right now, then I would have to figure out the gain or loss. So 110 minus 7,400 is 39,600. So I could have got 39,600 by just taking the 66,000 that it used to be and taking another year of depreciation at 26,400, and that's 39,600. And so that works. So the next year, I'm going to go here and I'm going to do 39,600 times 2/5. So you see how I'm doing it? See how I'm going on to each additional year? Oops. So 39,600 times 2/5 is 15,840. So now our numbers dropped. Our numbers dropped quite a bit. I mean, the first year was 44, and in the third year it's 15. If I was doing straight line, it would be 18, 18, 18, 18, 18. But double defining balance, more in the early years, accelerated. So let's go ahead and figure out what my accumulated depreciation is. Accumulated is the total of all 3 years, an accumulation of all the depreciation. 44, 26,400, and 15,840. 86,240. Okay, so where are we now? 110 minus 86,240. 23,760. Now I'm going to pause a second because something important is about to happen. So we're depreciating our asset, and if we were doing straight line, we would do 18, 18, 18, 18, 18, right? But we took so much in that first year. We took a lot in the second year too. And now our numbers are getting smaller, which is good because we are only allowed, this is the important part, we are only allowed to depreciate this asset $90,000. Because the cost is 110 and it's going to be worth 20 at the end. So we are only allowed to depreciate 90,000 because at the end of this asset's useful life, when this asset is all used up, it is worth 20. When it's all used up, it's worth 20. So once I hit 20, I have to stop. I'm sitting at 23,760. So I'm super close. So I'm going to take 23,760 times 2/5. And I got 9,504. Now, stop writing. Don't write anything. But if I did 9,504 right here, then my accumulated would be 95,744. And then I would do 110 minus 95,744. And I would get 14,256. This number right here cannot be below 20,000 because when I sell this asset, it's going to be worth 20. So I am not allowed to take 9,504. So I'm going to go ahead. Now you can start writing. I'm going to put the 9,504 over here. And then I'm going to cross it out. So I have a button that does that, but you can go to font and cross it out. So I don't know here. Right click. I don't even know where to do it. You guys know. I'm sure you know. Now it's kind of bothering me. Oh, I think it's just this little button right here. Oh, that's paste. Whew. Okay. Anyway, so I need to go to font and you need to cross through it. So And so it's not going to be 9504. I am not allowed to take 9504. I will, however, be allowed to take some because I'm allowed to get it to 20,000. So I only have 3,760 left that I can take. So I'm going to take 3,760. And if I take 3,760, because I know I can get it down to 20,000, then my total depreciation is 44, 26, 4, 15, 840, and 3760 is $90,000. And so then my total depreciation is $90,000. And 110 minus 90 is 20,000. And that is allowed. I am allowed to do that. So if I get 20,000 exactly, that means I am fully depreciated. I am done depreciating. So my depreciation expense in year 5 is going to be 0. I don't get any depreciation. So I'm not going to take 20,000 times 2/5 because I don't get any. I'm done depreciating. So my accumulated, if you add up all 5 years, is still going to be 90,000. And my book value is going to be 110 minus 90 is 20,000. So I had to finish depreciating the asset. I was all done in year 4 because of the accelerated system. So I got so much in this year that I ended up with none in this year. But in total, I still got a total of 90. So if I was doing straight line, I would have been 18, 18, 18, 18, 18. But year 4 depreciation is only going to be 3760, and we get no depreciation in year 5, 0. Okay. So as we're looking at the different methods, all of the methods write off the cost of the asset over time. It's just a different way of spreading it out. And so, and then for tax purposes, we use something called MAKERS, which is the modified accelerated cost recovery system. So it's an accelerated system like double declining balance. But then when it hits a certain point and the number drops below what the straight line number would be, then we just take the number that remains and spread it equally over the remaining years. And so we don't learn that method. We do it in tax class. And so my tax students are getting ready to do it, but you guys will not. And so just know that that's the method we use for tax purposes. If we had a partial year, we might have to do a fraction of the year in the first year, and then we would come in on a 6th year and do the other fraction. So there's that MAKERS conversation. So let's do one more example, and it's very similar to what you're going to do in your homework and project. So I want to work through this one. So this one has a nice table to it to kind of help you stay organized as you learn the 3 different methods. And so this is a review of all of the depreciation methods. So Joel Harvey Florist acquired a truck on January 1, 2007. The company paid $11,000 for the truck, $500 for destination charges, and $250 to paint the name on the side of the truck. So all the costs to get the asset to you and ready for use are part of the cost of the asset. So it looks like our truck's cost is $11,750. It's the 11 and the 500 in destination charges and the $250 to paint the name on the side. So we are going to use the truck over a 5-year period. So that's important. And it has a residual of $1,750. So that's the information we need for straight line. Also, it looks like we're going to drive the truck 100,000 miles, and we have the actual miles we drove it. Well, you need that for units of production. And then for double declining balance, we just need book value times 2/5. So we'll go through that. So let's go ahead and let's fill out this happy little table here. So for straight line, my formula to review is cost minus residual divided by years. And you don't have to write the formula right there. I'm just showing you, okay? So cost minus residual over years. The cost of my asset is $11,750. The residual is $1,750. And I'm going to divide by the years, which is 5. Okay. So my depreciation expense goes on the income statement. And so the income statement will show each year's depreciation, whereas the balance sheet will show cost minus accumulated. Cost is an asset. It's what you paid for it. And then accumulated is a contra to show the book value. So we'll take 11,750 minus 1,750, which is 10,000 divided by 5, which is 2,000 each year. Now, with straight line, it will be the same each year. So we don't have to recompute it each year. It's the same amount every single year. So straight line is pretty simple. The cost of the asset when we bought it was $11,750. The cost of the asset never changed. We didn't do anything to that to change it. And so it would stay as an asset on the balance sheet at $11,750 for the whole time we own it. But accumulated does change because accumulated is an accumulation of all of the depreciation. So in the first year, it's 2 because it was just 1 year. And then in the second year, it's 2 years, and then 3 years, 4 years, and 5 years. So accumulation of all of the depreciation. And so then cost minus accumulated is the book value. So the book value at the end of year 1 would be $11,750 minus 2. So $97.50, and then $11,750 minus 4. $77.50, $57.50, $37.50, and $17.50. Okay, so at the end of the asset's useful life, it is worth $17.50, which is the residual value. Okay, so this table is just a way to kind of show my work. And so you guys will get to do that for homework, and it should be pretty pleasant. Okay, so the next method is units of production. Units of production, the top part will be exactly the same, but downstairs, instead of 5 years, it will be some kind of usage. Like my copy machine can copy 500,000 pages, and so it will be 500,000 copies. But this one, again, is miles. So it says that we expect the asset to be driven 100,000 miles. So what we're going to do is we're going to do 11,750 minus 1750. And then we're going to divide by 100,000. Make that smaller so it fits. Okay, so that will give me an amount per mile. So in the top part, it's 10,000 divided by 100,000. So it's 0.1 per mile, 0.10 per mile. And then I just need to know the number of miles that I drive. And so in the first year, I'm going to drive this asset 15,000 miles. So 15,000 miles at 10 cents a mile. So 1,500. And in year 2, it was 25,000. So I would take 25,000 times 0.10. And the next year, it was 30,000 times 0.10. I didn't have room to show my work on this first one, but if you can somehow fit it in or just draw an arrow to it, we took 15,000 times 0.10. Okay, 30,000. The next year was 25 and then 5. Okay, so 25,000 times 0.1 is 2,500. Then 3,000, 2,500, and 500. So that's what shows up on the income statement as an expense. And then my cost of my asset never changes. It's just 11,750. Oh no. All right. There we go. And so accumulated is the total depreciation. In the first year, it's 1,500. In the second year, it's 1,500 and 2,500. And then it's 1,500, 2,500, and 3,000. Add another 2,500 and then add another 500. Cost minus accumulated. So I would take 11,750 minus 1,500. In the first year, it would be 10,250. 11,750 minus 4 is 7,750. 11,750 minus 7 is 4,750. 11,750 minus 9,500. I have no idea. 2,250. And 11,750 minus 10 is 1,750. So notice that it ends at 1,750 in both situations. At the end of its useful life, the asset is worth 1,750. Okay, last method, double declining balance. So this one, remember our formula here is book value times 2 divided by years. I didn't write my formula here, but I probably should. Cost minus residual divided by usage. Okay. So, okay. So book value times 2 divided by years, because it's double. Double means 2. And in this situation, we have a 5-year asset again. So in the first year, now on this one, you guys, when we were doing the previous ones, we did like all of them. And then we went through and did all of them. And we kind of moved down the columns. But here we have to move across the row because I need the book value to go on to the next row. I need the book value to go on to the next row and so on. So what we're going to do here is we're going to do the book value times 2/5. So when this asset starts, we have no accumulated because we haven't started depreciating yet. So we'll take 11,750 times 2/5. So 11,750 times 2 divided by 5 is 4,700 in year 1. Now comparing that to this method, it's more than double what we would get in year 1 with straight line. So just pointing out this accelerated method. So cost of the asset, 11,750. Now that I can go ahead and fill down the whole way because it's always going to be 11,750. The cost of the asset doesn't change. But accumulated is 4,700. So 11,750 minus 4,700 gives me 7050. And then I can move on to the next row. And I will do 7050 because the formula is book value. And every year the book value is going to dwindle times 2/5. So 7050 times 2/5 is 2820. So my total depreciation is 4,700 and 2820. So I'm at 7520. So if I take 11,750 minus 7520, oops, sorry. 11,750 minus 7520. What was happening? Okay, sorry. 4230. Go on to the next row. I feel like I'm getting close though already. This number cannot go below 11 or 1750. So we have to stop at the residual. So I'm just keeping an eye on it. I don't use the residual in any of my calculations, but as I get close, I'm paying attention. This book value is not allowed to drop below 1750. So kind of paying attention to it. We'll see how far we can get. 4230 times 2/5, 1692. I think I'm still okay. Total depreciation, accumulated depreciation is 4,700, 2820, and 1692, 9212. If I got to that number and it was less than 1750, I'd have to stop and fix stuff. I think I'm okay right now. 2538. Okay, I'm gonna keep going. For the next year, I'll take 2538 times 2/5. 1,015.20. Okay. If I take 1,000 though, I'm going to be down at 1,500. So I need to stop myself. So I'm going to go ahead here and write 1,015.20. Then I'm going to cross through it. Cool. I can't figure out how to do that. My brain's not working today. Okay, so I cannot take 1,015.20 and I need to figure out how much I can take. I'm at 2538. I am only allowed to get down to 1750. So I'm going to take 2538 minus 1750 to see how much I'm allowed to take. Last time it was really obvious because it was like 23,760 and I was like, I only get 3,760. But I'm only allowed to take $788. $788 will get me down to the number I can use. So 2538 minus 1750, because I'm only allowed to go down to 750, means I only have 788 left that I can take. So if I take 788, then I'm going to take 4,700, 7520, oops, sorry, 4,700, 2820, 1692, and 788, 10,000. So then 11,750 minus 10 is 1,750. And then in year 5, no depreciation. So my accumulated will still be 10,000 and I'll be at 1750. So in whatever year you run out, that's when you stop. Because if the book value, if the salvage value would have been $500, I could have kept going, but it wasn't. It was 1750, so I had to stop in year 4. Okay, on December 31, Joel sold the truck for 3,000. On December 31, 2011, compute the gain or loss. All right, so I don't know what method we're using to know that. So, oh, I guess it doesn't matter because we're selling it on December 31. So of 2011. So the asset is fully depreciated. And so I was wondering what method we used because I was like, what year is that? But we waited till it was fully depreciated. So the book value in all of the situations are 1750. So it doesn't matter. Okay, so let's do the journal entry to show this. But we can also say one other thing. We can say book value versus selling price. And so we would say the book value is 1750 versus 3,000. And so we have a gain of 1250. But if we wanted to do it as a journal entry, just to show you guys, and I know there's no journal entry paper right here, but we would say cash 3,000. I know I'm out of room, so I'm going to actually make all of this smaller to get it to fit on the page. Okay, so I'm going to go to the 4th row and credit equipment. And the equipment's cost was 11,750. I'm going to debit accumulated, and the accumulated is 10,000. And then my difference is a gain. I have 13,000 of debits, so my gain would be 1250. So you did not have to do the journal entry for that, but I was just kind of showing you what it would look like. So if we sold the asset for more than its book value, that's what it would look like. I kind of wish it would have said we sold the asset for $500. And so I kind of want to do that instead. So let's sell it for $500 over here. Sell for 500. And so then we would show cash coming in at 500. My accumulated is still 10,000. The bottom row for equipment is still 11,750, but now I have debits of 10,500. So I would need a loss, and then I would say 11,750 minus 10,000 minus 500, and my loss is 1250. So that's just an example of what the loss entry would look like, because you would sell it for less than the book value. So, okay, guys, I hope that makes sense. I hope everybody followed that through. Okay, you're not going to do any gains and losses and stuff, I don't think, on your homework or anything. It's really just more calculating depreciation. So I hope you feel good about that. This is very similar to your homework. So when I do your homework helper video, you'll get to see that. So I hope you guys are doing well, and I will talk to you later. Thanks.